Starting with the global macro picture, while several central banks have been cutting policy rates, long-term bond yields have been inching higher. For instance, US Fed has cut rates by around 175 bips point in this easing cycle, yet a 10-year US Treasury yield is up roughly 50 basis points. Then there is the case of Japan, where yield have climbed nearly 130 bips, touching a 50-year high. What is your take on this?
You started with a very tough one, Sonal. But that is true. I think if you had asked anybody year and a half ago, they would have expected that as many of these central banks embark on an easing cycle, there would be a dramatic compression of long-term bond yields. That has not happened. There are many reasons for this, including the fact that many economies have continued to keep their foot on the fiscal pedal, and therefore, as a result of that, even though the Fed has cut short-term interest rates in the case of the US, long-term bond yields have not responded to that because of the pressure of issuance from the center, and therefore a rising term premium on concerns both about issuance, size of the fiscal deficit, and also about inflation. Remember that in the US, even though they have cut rates, actually the reported inflation number is actually above their target level. Finally, of course, we come to the case of Japan, where we're not really discussing cuts. But the fact of the matter is that Japanese bond yields have moved up very, very sharply. This is a big change, Sonal, from previous environments where every time there was, any sort of turmoil in global capital markets, you would immediately see the yen depreciates and you would see Japanese bond yields go down. As a result of that, the Japanese bond market was the favorite borrowing ground for carry traders across the world, borrowing money in yen, a cheap currency in terms of the cost of capital, and using that to deploy it in other parts of the world where higher yields were available. So this was really the origin of the yen carry trade. But as you can see on this chart, the spike in rates in Japan has been very, very significant. Combination of high fiscal deficit, combination of the weak yen, and of course much higher inflation than their target level is, and therefore the 10-year bond yield has spiked all the way to 3.4%, highest that you can see on the chart. But in fact, it's also a 50-year high, and that does create concerns about the fact that many investors who were using this carry trade to borrow cheap in Japan and invest elsewhere in the world are now having to unwind that trade. And that could be something that could, pose a little bit of risk to financial markets across the world, particularly as far as leverage trades are concerned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.